Let's start with rents, which seem to keep going up despite what we're hearing about housing prices overall, given mortgage rates, as Diana was just describing, moving up and making it more or less affordable for buyers.
Yeah, you and Kramer talked this morning, David, about rents being a component of inflation and how there is really nothing abating that upward tick in rents. It's really a supply and demand issue. Apartment buildings across the country are full, and they are able to push rents right now. And until we see more supply come online, you're going to continue to have that problem.
So your expectation is rents will continue to either maintain and or continue to move higher?
They'll continue to go up. Everyone that we work with is pro-forming somewhere north of 5% rent increase over the next year. And so until you see that come down to the historic average of 2 to 3%, you're not going to see that number kind of abate, if you will, in the inflation.
So from an investor perspective and or those who are actually lending, multifamily is the place to be right now?
Multifamily is a great place to be. One of the big reasons for that is the agencies, Fannie and Freddie, that provide liquidity to that market. There isn't that liquidity in other commercial real estate asset classes. But as Diana just said, the market has changed dramatically as it relates to Fannie and Freddie from a lending standpoint. Crisis, great financial crisis, the loans that she was just talking about, that doesn't happen today. They're much different organizations today. And so that liquidity that they provide to the market is extremely helpful.
They have a lot of capacity. I mean, I'm just looking here at the transcript from your last earnings call. 59% of their annual lending capacity still intact. That was a couple of months ago. But nonetheless, are your expectations that they're going to take a bigger and bigger share then?
They will. You look at the broader commercial real estate markets and where spreads have gone and CMBS and CLOs, that market is, for all practical purposes, closed down right now. Spreads have gapped out so much that getting loans securitized through that execution is tough. I think the big question right now, David, is why aren't banks lending? You saw earlier Bob Pisani talking about the fact that banks are trading at ridiculously low multiples right now. The reason they're trading at ridiculously low multiples is because they're not lending. They're overcapitalized by over $3 trillion, and they've all pulled back. And so them pulling back in the commercial real estate sector right now has made it so that the entire, if you will, chain has stopped moving. And so you can't get warehouse lines right now. You can't get syndicates to go and syndicate loans. And so as a result of that, we're getting a real pullback from lending from the major money center banks. And that has basically slowed down the entire financing system.
So why is that happening? Is that a sign as we go into bank earnings here in the next couple of days that banks are cautious? Is it a regulatory situation?
Morgan, it's such a great question because in Q2, commercial banks in America, their net charge-offs for commercial real estate was 1 basis point. One. Okay? Their commercial real estate portfolio delinquencies were at 70 basis points. That got up to almost 9% during the great financial crisis. So they're bracing for something to happen, but it certainly has not started to happen. From an overall credit standpoint, it's an incredibly clean book.
So then what does this do to the supply conversation that we started this interview with? Can enough supply come online to see something like rents, for example, in multifamily homes abate?
Well, it's a combination of both keeping single-family production going, which has slowed down dramatically, as Diana just said. That market is very challenged from where interest rates have gone in the purchase market. And until you get more supply in both single-family as well as multifamily, rents on multifamily are going to continue to go up.
What kind of number would you need to see on starts or permits to say that the housing market's beginning to equalize?
So the big problem there, Carl, is that if you think about it, we need to have over 1 million single-family home starts going, and that's just pulled back below that recently. And so with the current financing market and with interest rates at 7% on a mortgage that Diana just talked about, it's very hard for new shovels to go into the ground on the single-family side. On the multifamily side, starts over the summer were at all-time highs. So you are seeing it on the multifamily side, but that's an 18 to 24-month lag as it relates to when that inventory will be supplied.
And that's not counting labor or supply chains, things about getting those shovels in grounds, right?
That's correct. And you're seeing some abatement there. You are seeing prices as it relates to lumber and other inputs going down, but it's not giving developers a lot of confidence to go start new starts.
Willie, our viewers may recall having brought you on a number of times. We talked about return to the office, kind of an endless topic. Have we hit an equilibrium? I'm looking at a report today from Bank of America on spending. You know, in terms of spending in central business districts, things have sort of equalized, but they are nowhere near in New York, San Francisco, or Boston where they were in 2019. They say, suggesting a large and potentially permanent shift towards hybrid work in these cities. What are you seeing?
We're certainly seeing that, David. It's hard for CEOs to get people back into the office, to be honest with you. We've changed at W&D. We've gone from back to the office to forward to work, trying to deal with the kind of the new normal of online as well as in the office. And I think as CEOs, rather than kind of sitting there, we've seen Jamie Dimon sit there and say, got to get back to the office, got to get back to the office. I think if CEOs can change their outlook to saying, let's work in this new format, that they can actually get people and feel like we're not trying to go back to 2019, we're trying to go forward to 2023.
And finally, we don't talk often about your company, but I noticed obviously on the call you said you're generating a huge amount of cash. You're going to use that to continue to invest, but also return capital. Which is it? Which one right now, given all the things you're describing? Do you want to invest more, or are you looking more for dividends and share buybacks?
So I mean, if you look at how we did during the great financial crisis, when everyone else was really hurting, we did incredibly well and went public on the backs of that success. When the pandemic hit, our stock sold off immensely and then all of a sudden rebounded and went up dramatically. We are somewhat of a countercyclical play, and so we are holding on to cash right now and trying to be very opportunistic. There's going to be a lot of opportunities for us in 2023.
All right. Well, we look forward to talking to you about them as well. But, Willie, thanks for stopping by today.
My pleasure. Thank you.